The COVID-19 pandemic was like a giant economic experiment, unlike anything we'd ever witnessed. It was a real-life stress test for the global economy, and the results were both shocking and illuminating. Overnight, the world came to a screeching halt. Businesses shut their doors, global travel evaporated, and unemployment soared to levels not seen since the Great Depression. It was a deflationary shockwave, the kind that, according to traditional economic theory, should have triggered a massive collapse in asset prices. I mean, if you think about a deflationary event, I don't think we have ever had something close to that in our history. Perhaps only the Black Plague from the 14th century, but I guess there wasn't a lot of data gathered back then. Other than that, I can't think of an event that should have crushed the price of everything as much as the COVID shutdowns. We literally stopped the whole planet for over a year. A barrel of oil went down to negative prices because people literally did not even want to store it anymore. There was a picture I saw from an Indian town in which 40-year-old people were saying that for the first time they're able to see the Himalayan mountains in the distance, which are over 200 kilometers away. The reason was that there was such a lack of traffic, airplanes, and factories working that the air became the cleanest it had been their whole life. Literally, if there was an event that should have caused terrible deflation and asset price collapses created for a textbook, this would have been it. But then, something unexpected for the unprepared mind happened. Instead of crashing and burning, the markets went on an absolute tear. Stock markets rebounded with astonishing speed, real estate prices continued to climb, crypto, gold, everything reached an all-time high in 2020. And then, inflation got on a rampage, and the developed world saw the biggest inflationary shock and loss of purchasing power for decades. How could this be? The answer lies in the unprecedented response from governments and central banks around the world. They unleashed a tidal wave of stimulus, injecting trillions of dollars into the system to prop up businesses, support workers, and crucially, prevent a financial meltdown. If we go back to our charts, the Federal Reserve increased its balance sheet from 4 trillion to almost 9 trillion in the span of 2 years. And what is most important, during the months of March to June 2020, they increased it from 4 trillion to 7 trillion, the fastest increase ever. The picture looked the same in Europe. I want you to notice something. This is a chart of the S&P 500 between March and August 2020. Notice how it dropped sharply in March. This was supposed to be only the start. And in that time, the people with cash should have been able to capitalize and buy cheap S&P shares at a huge discount. However, that didn't last long. Only 4 months after that, not only had the S&P recovered, but it reached an all-time high. Isn't it weird that at the exact same time, the balance sheet, or the money printed in other words, of the Federal Reserve did this, the stock market went to an all-time high and did this. If that doesn't connect the dots for you, then I'm sorry, I'm powerless to help. This created a stark disconnect between the real economy, which was suffering immensely, and the financial markets, which were thriving. It was a surreal situation, like watching two completely different movies playing out on the same screen. The COVID-19 experiment revealed a fundamental truth. The old rules of investing, the ones that told us to keep a lot of cash and bonds in the case of recessions and depressions, do not apply anymore. Governments and central banks have shown they are willing to go to extraordinary lengths to prevent a collapse, even if it means distorting markets and creating potential long-term risks. The pandemic served as a wake-up call, a stark reminder that the economic landscape has shifted. It forced us to rethink the role of debt, the effectiveness of monetary policy, and the very nature of what constitutes a safe investment. Because if you think about it, a lot of people consider something like cash safe and something like stocks or Bitcoin risky. However, isn't it weird that in the biggest crisis of our times, the safe investment has lost over 40% of its value in the past 4 years, while the risky ones gained tens and even hundreds of percentages? I think by showing you this, we are now on the same page, that the game has completely changed. This is just a part of my video about how the rules of money and the economy have changed. To check the full version, click on the video that should have appeared on your screen right now.